there are three big forces to keep your eye on. And when you see them in their cycle, then it's clear. First, are you earning more than you are spending? When you look at those three forces, I want to make sure that they're clear and you could align them up and you could see where you are. Is the country earning more than it's spending and building savings? Or is it spending more than it is earning and creating debt? Because one man's debts are another man's assets. And when somebody is holding those assets and they're producing a lot more of that money in debt, they go down in value. Money goes down in value as they produce it to produce that buying power. And then that gets people bad returns. It produces a higher amount of inflation, and it produces bad returns for holding debt, or so in other words, cash or bonds. And then people get out of cash and bonds, and that produces rising interest rates while there's rising inflation, and that produces stagflation. So I want them to get the mechanics of that, because that's happening now. You could see it. This is not controversial. We're on the brink of war with China for various reasons. I hope we make it to 2050. The demographics is as I describe it. And by the way, them losing doesn't make us winning. So I think you're in the part of the cycle where you've had the tightening and the dominoes are beginning to fall. And I think that that's going to produce more problems. The most important thing is to have this basic, well-diversified portfolios. You don't want to be in a war. So, and those places, investing-wise, history has shown, do worse because they have to spend more money, there's more problems, more pain that's being exchanged. Neutral countries in wars do very well, as it turns out. So, elements of diversification. I would not want to be in debt or cash and those instruments. I would want to diversify well, with a bias toward inflation-protected assets. And I would want to diversify between locations, countries, in terms of the investment based on the criteria I've just mentioned. We are in a shooting war of sorts with Russia and the Ukraine. We're providing arms, and so they're shooting. And so there's a military war going on, and we're in it in our way. So we're at those particular spots. And the capital war is sanctions. We hear the notion of sanctions. And what that means is they're economic. And the way they work is to shut off, to produce economic pain by either not letting them get at their money or not letting them get to goods that they can import. And these have happened through time. In Japan, that was what set us up for the bombing of Pearl Harbor, because the United States cut off Japan's oil supply, was in the process of doing that, and also confiscated its bonds, much the same way is happening now. And that put them into a corner that led them to bomb Pearl Harbor, and then we went to a military war. So that's where we are now, and that also is risky because it threatens the value of the dollar. Because right now, debt is dollars. Any currency, the way you hold it is you hold it in the form of debt. You don't hold it just in paper. And because there's a rising inflation, and because there's a lot of printing of money, and because there's also a greater fear on a number of countries that they too could be sanctioned, there is a selling of dollar-denominated debt. So you're seeing that the bond market is going down. My goal here is to show people how the machine works, the cause-effect relationship. The dollar is held by countries in the form of debt. In other words, when you say I'm holding the dollar, you're holding a debt instrument. And when we have a problem with the debt instrument, a few problems with it, holding debt instruments, those problems are that, first of all, as a result of what the United States was in the world, the largest trading country, the dominant empire, and so on. There's been a huge accumulation of dollar-denominated debt, in dollars, therefore, and there's also been a lot of deficits that had to be funded, which happens by selling dollar-denominated debt, which a lot of foreigners and banks and others bought. And so they have a lot of dollar-denominated debt. Now, if you're a creditor, meaning an owner of dollar-denominated debt, you need to have an interest rate that is high enough to more than compensate you for inflation. And so the production now of a lot more debt and them having a lot of debt, and then also sanctions internationally, which means freezing dollar-denominated debt, all have created a reduction in the demand for dollar-denominated debt. There's also, concerns in the world about some of the things that are going on in the United States, and that's reduced that. As a result of that, you're seeing more transactions take place in other currencies. And if they take place in other currencies, then others want to save in those other currencies because that's how they pay for it. So if you want to save in what you pay for, you save more in it and less in dollars. And so that's the dynamic that is reducing the demand for dollars and dollar debt at the same time as the supply of it keeps coming because we have large deficits. There's a business cycle, or a short-term debt cycle, I call it, that, sort of recession to recession. And the way it works is you have a recession and weak economy, central banks stimulate credit growth. Credit gives you buying power. You go out and buy, the economy picks up, and then that continues until you start to have inflation. Then they tighten monetary policy, and then the economy weakens and it goes into the next recession. Since 1945, when the New World Order began, in other words, we had the currency and also the American World Order beginning in that, we've had 12 and a half of those cycles. They typically last about 7 years, give or take about 3. And so we are now about halfway through this cycle in which they did the stimulation, inflation rises, they tighten monetary policy, and we're in the phase of the cycle where there's going to be then the cracks occurring and the negative impact on economic activity and the like. And it's going to be more difficult than normal because there's so much debt outstanding, and we're, what we just talked about. So that is likely to happen over, let's say, the next year and a half, which means that it will take us in through the elections. And what we have is a situation where the second of those influences, the internal conflict influence, is bad, and you have a lot of populism. So populists are people who will fight to win at all costs. They're not compromisers. I will fight and I will win for you, and the rules be damned, compromising be damned. And so you're going to have a political situation in terms of, that kind of environment. It's a bad time for that, but it'll end up having an impact on the nature of the elections, I think. And then you have the international conflict. I'm looking at, if I go down countries, is first, are they earning more than they're spending? Do they have a good income statement and balance sheet? This is going to be very important in the period ahead, because the amount of credit that's going to be available to bridge the gap between spending and earning, cash flows and so on, is going to be quite narrower. So a lot of companies even that were able to raise cash and not have good cash flow because of maybe growth expectations in the future will find it more difficult.